Hello, and welcome to our second part of debits and credits. In the first part, we looked at the simple balance sheet identity formula, or the standard formula that we use in accounting all the time: assets equals liabilities plus owner's equity. And you memorized that formula, and then we added this idea or rule that accounts on the left, or things on the left, go up on the left, and things on the right go up on the right. And so we went through a process of trying to identify types of assets like cash and accounts receivable and inventory, and different types of liabilities like accounts payable or notes payable, and equity accounts, which are commonly our capital or common stock accounts. And then once we knew where accounts fit in the equation, that is, whether or not they were assets, liabilities, or equities, we could go through the process of sort of analyzing transactions and figuring out what happened. And so we went through this 4-step process of trying to determine what are the accounts that are impacted, where do the accounts sit in the equation, and then are the accounts increasing or decreasing. And then from that, we could determine our debits and credits for any given transaction, so long as it primarily just impacted assets, liabilities, and equities. And we sort of left off at that point and didn't discuss revenue and expenses. So our general rule, assets equals liabilities plus owner's equity, and things on the left go up on the left and things go up on the right, is a true statement, but there are a few accounts that are exceptions. And the exceptions are the revenues and expenses, and then contra accounts. And so revenue and expenses, you can see them here sitting in the bottom of the slide below the owner's equity. And the way I think about debits and credits on revenues and expenses is by working off of what we already know. And so one way to do this is just to imagine what is happening with cash and then work into the revenue or expense from that. So for example, if I make a sale for cash, cash is an asset, it's on the left, it's going up on the left, so cash is the debit, and so sales or revenue must be the credit in order to make the transaction balance. And additionally, or conversely, if I pay rent expense with cash, asset or cash is on the left, it goes up on the left, so it goes down on the right. So cash is the credit, and so the expense must be the debit. So you can kind of use your understanding of what's happening with cash to kind of back into what's happening with the revenues and the expenses. An alternative way to think about revenue and expenses is to notice that revenue and owner's equity move in parallel. So the way I think about this is that business owners, if you've ever known any of them or worked for somebody who owned a business, they are just nutso bonkers about revenue. I mean, they watch for revenue, they look for revenue, they close the till at the end of the day to see what the revenue is. Owners just love revenue. So equity and revenue walk hand in hand, or they run a parallel relationship. And so you can see that revenue behaves the same as equity. Conversely, then, expenses are an owner's enemy, and so you can see that the expenses are the opposite of the owner's equity. And so those are two tricks for how to think about revenue and expenses. One is to create an imaginary cash transaction in your mind for either a revenue or expense, solve for the cash, and then know that the revenue or the expense would then, you can sort of back into that because you know the debits have to equal the credits. Or to think about how equity behaves and recognize that revenue behaves the same as equity and expenses behave the opposite of equity. Whichever rule works for you is the one that I would deploy, just so long as you can kind of consistently land at the correct debits and credits for revenues and expenses. So here's some examples. A business pays $1,200 cash for rent, and so I'm going to work off the cash here. My cash is going out, and so my cash is on the left in my original formula, assets equals liabilities plus owner's equity. So cash would go up with a debit, and it would go down with a credit. So when this business pays $1,200 cash for rent expense, I'm going to debit the rent expense and credit the cash. So let's take the second one. A business makes a cash sale for $500. So cash is an asset. It's on the left. It goes up on the left. So I'm going to debit cash for $500 and credit sales for $500. A business purchases $300 in office supplies on account. So I don't really know what's happening with office supplies yet because I'm new and I'm learning my expenses, but I'm going to take on account. So I need to increase accounts payable, which is on the right side of my equation. And so I'm going to do a credit to accounts payable. And so I'm going to do a debit to office supplies expense. A business makes a sale of $600 on account. So I need to increase accounts receivable, which is an asset. It's on the left, so it goes up on the left. So I'm going to have a debit to accounts receivable, and thus I'm going to have a credit of $600 to sales. And so that's just how I go about trying to think about revenues and expenses. I hope that works for you. I encourage you to, in all these cases, break out your pencil and start drawing T accounts, filling in the equation, and you can use the equation and the T accounts and our rules that we've kind of laid out here to help you arrive at the revenue and expense debits and credits. So the other exception to our general rule besides revenue and expenses are contra accounts. And contra accounts are they're accounts that are attached to a parent account. So they're like a subsidiary account or a child account or in essence a contra account, but they're attached to a parent account, and whatever parent account they're attached to, they work the opposite from that parent account. And so some examples of our contra accounts would be draws, which is a reduction in capital, dividends, which is a reduction in owner's equity in the corporate form, accumulated depreciation, which is a reduction in a fixed asset, and then allowance for doubtful accounts, purchase returns and allowances, purchase discounts, sales returns, and sales returns and allowances, which are all reductions of the various parent accounts that they're attached to. Now, you will see allowance for doubtful accounts when you get to the accounts receivable chapter, and then when we deal with inventory, we'll deal with purchase returns and allowances, purchase discounts, sales returns and allowances, and sales discounts. But let's focus in for a moment just on what's happening with, with a fixed asset account. So you can see here I've kind of created a T account for a fixed asset in the upper part, and then in a slightly smaller size and font, I've created an accumulated depreciation account. And I often think of these contra accounts as teenagers. They're still attached to the parent account, but they behave just the opposite no matter what. And so we know that a fixed asset is an asset account. And so it goes up on the left and down on the right. And so by definition, our accumulated depreciation contra account has to behave the opposite. And so once you know where a contra account attaches to the parent account, you can identify where the parent account sits in the accounting equation. And then once you know how the parent account behaves, you can determine how the how the contra account, or in this case the accumulated depreciation account, behaves. That's a lot of accounts and a lot of behaviors. The reason why we use contra accounts, we could just as easily reduce a fixed asset by putting a credit in the fixed asset column of the T account here, but instead we isolate the reduction in the accumulated depreciation account because we need the information separately. So there are going to be times when people ask us, well, what did you originally pay for that asset? We want to be able to look at our trial balance and see the historic cost, the original cost in the fixed asset account for that asset. And then at other times, people are going to say, well, what's the book value, which is going to be the historic cost less the total accumulated depreciation. And so we want to be able to see the total accumulated depreciation separately also. So when we need to isolate a piece of information that is related to a parent account, we will often set it aside in one of these contra accounts. So that's kind of the reason why we have these things. We don't make them up just to make the lives of accounting students miserable. There's actually a purpose for them. So here are some examples of some contra account transactions. So we're going to reduce equity by paying a draw or dividends. So the draw or dividends account, the draw would be a contra account to capital, and the dividends account would usually be a contra account to common stock or a reduction in retained earnings. And so when we pay that dividend, we're going to credit cash, but we're going to debit either the draw or the dividends account, which that debit in the contra account is going to reduce the overall credit balance in the parent equity account. That one's a little bit difficult, but let's go on to the next one. Reducing a fixed asset with depreciation. So in this case, we would debit depreciation expense, recognizing the using up or consumption of that particular fixed asset, and we would credit accumulated depreciation to sort of isolate the amount of depreciation that we have taken, thus retaining the historic cost of the fixed asset on our books. But now the book value would be the fixed asset's historic cost less the accumulated depreciation that we had taken. And in the last one, reducing sales with a customer return. So one way to think about this is to go right to what's happening with sales. So sales would normally be a credit. So to do a sales returns and allowances, we would normally debit the sales return and allowance and then credit either cash if it was going back to the customer or a reduction of their accounts payable depending upon how they had originally completed the transaction. So you can work through these contra accounts. You know, honestly, this is a case where it makes a lot of sense to draw a T account for the parent, whether it be an equity account, a fixed asset, or the sales account, understand what's happening with the parent account, and then draw the contra T account and figure out how it behaves so that you can work into the debits and credits on the contra accounts. But armed with this data, the assets equals liabilities plus owner's equity, things on the left go up on the left, things on the right go up on the right. Revenue walks in hand with equity, expenses work the opposite, or using our cash examples for an expense or a revenue to back into the debits and credits with revenues and expenses, and then adding with that how contra accounts behave, you're now in a position where you can do all of the debits and credits that potentially come your direction. So I wish you good luck with those, and please join us again next time for some further studies. Take care.